Hey founders, Kirk Mitchie with Canada Advisors here. The week is July 17th, 2023. Hope you're all enjoying your summer, whether you're working from the beach or an office or home. Here in Southern California where we are, it's absolutely gorgeous. Thought I would share with you a story that came about in the last couple of weeks. Was talking to a business owner, small company guy, who knows, maybe someday he sells for a lot of money, but right now, he's a general contractor with some subcontractors, neat little business. Um, and I used the phrase adjusted EBITDA with him in describing how valuation of a private company was done. And he perked up and said, "Oh, that's what Charlie Munger calls bullshit earnings." And we both had a good laugh over that. Then we got into a productive discussion about why it is that Charlie Munger, Warren Buffett's partner, two of the greatest investors of all time, Berkshire Hathaway, would call the metric whereby buyout or deal professionals use for valuation, and spend a lot of time calculating and adjusting and making sure it's right, why a couple of the greatest investors of all time would have such a low opinion of that metric. And it's pretty simple. So Warren and Charlie are buying public companies. There are all kinds of accounting standards that public companies have to go through, including fair disclosure and Sarbanes-Oxley, and a lot of things that as a non-tax advisor, as a non-tax professional, I can't even get into the depth of. I'll just tell you that when you're looking at public company earnings, you need to be looking at earnings that have been prepared in a uniform way so that when you compare the earnings of Meta to the earnings of Alphabet, you know that they're using the same accounting standards and nobody's pulling any shenanigans about how one ought to be valuing some form of their revenue stream a different way than the other one. So that's very, very important in the public markets. And that's where Warren and Charlie invest. In the private markets, what is happening is EBITDA is used so that you can get a better sense of the cash flow of the business, regardless of the type of entity or the corporate structure of the buyer and the seller. What I mean by that is simply this. Let's say a C corporation public company is buying an S corp or LLC private company. Well, the S corp or LLC is a pass-through entity. So the owner or owners of that business are paying taxes as they are passed through the business to them. And they're probably running a lot of their personal expenses through the business. So the net income of that business is not necessarily reflective of all of the transferable economics of that business. So minimally, the C Corp and the S Corp or LLC have different tax rates. So that's why you've got to adjust for the T in EBITDA, the tax piece. Now, the interest piece is a little more complex in the sense that most buyouts are done cash-free, debt-free, which means that the seller gets to keep their cash adjusted for working capital or anything they kind of need to leave on the balance sheet as part of the transaction, as long as they pay off their debts. And since they're paying off their debts, there's no more interest. So there's the I in the EBITDA. So the T and the I, they're gone. Now, because the buyer is acquiring either all the stock of, meaning everything that the business owns, or all the assets and liabilities of, meaning all the things that the business owns, but not necessarily the stock. But in either case, buying everything about the business, depreciation and amortization are going to be different because now all those assets have a step up in basis. And so there is no longer a depreciation schedule or an amortization schedule for property, plant, equipment, the assets of the business, because the buyer now acquires them and steps up that basis. So there goes the D and the A, EBITDA. So take the earnings and change the tax rate, take away the interest, get rid of the depreciation and amortization. Now you can say those are the transferable economics of the business. Now, if we're talking about a public company, doing the accounting that way, I'd agree with Charlie and Warren. Those are bullshit earnings. On the other hand, if I'm a C Corp buying an S Corp, I need to know EBITDA. I don't care about net income. I need to know EBITDA. So completely agree with Warren and Charlie on the BS earnings piece as it relates to a public company. As it relates to M&A professionals, they got to use kind of a uniform standard there that equilibrates the transferable economics, regardless of the entity type lying. So that's a lot for a summer break. If we can provide additional information like that in other areas, please navigate to the insights section of candor-advisors.com. If there's something specific I can help with on your business, click on the call to action green button on the website. It says talk to Kirk. Give me a sense of what your situation is and what the urgency is, and we'll get back to you just as soon as we can. Thanks. Have a fantastic week and a great summer.